Welcome to the Capital Discussions Roundtable. I'm Baker with Jim Riggio and our guest, Don Kaufman from Simpler Options. Before we get started today, a quick disclaimer: the Capital broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So once again, this is for educational purposes only, and I'll turn the ball over to you, Don, so you can share your screen. But this is the first time we've actually talked. I was with Dan Sheridan for many years. I'm familiar with your through Think or Swim, so it's nice to finally meet you. And obviously, you and Jim go back a long way. So welcome.
Yeah, thanks. And I'm gonna figure out how to do this here momentarily. So I'm gonna be sharing a screen over here. Just give me 1 second. I'm using 6 different monitors, right? So it pains me to actually say that, but since I since I started working a little bit more, day to day over here, I was like, you know what? I'm going to bump up the number of monitors. So I find myself with 4 monitors. That's not enough. So I started trading again pretty extensively about 9 months ago when I left TD Ameritrade. I traded a ton over the years, but I really started to kind of amp it up and started adding more screens and more monitors. Next thing, I've got myself like the standing desk, the 6 monitors over here. Totally unnecessary. It really is. I don't need all this, but I am very amused with all the technology that's out there today. So we're gonna talk a little bit about probability, volatility here. I'm gonna make sure I can read some questions as we go along. I encourage you guys to fire questions in. And no, I don't think I have a cold. I should sound just fine over here. Different headset than I normally wear, though. Some headset issue over here. So let's kind of jump into it. And again, if you guys have questions, I've got the chat up and running. Tom, you see the screen all right over here, and good font size. Everybody read everything okay?
Looks good to me. I'm looking at an SPX chart, so hopefully we're seeing the right thing.
All right. I promise that's almost the last chart you're going to see this during this, because again, I'm going to talk a little bit more about probability, volatility. Hopefully not ruffle too many feathers, and we'll kind of get into it over here. Yeah, so over the years, it just looks like I'm looking at some of the names in the list over here. I was just looking a moment ago, and funny enough is I actually recognize a huge number. So I've known Jim for extremely long time over here. I think Jim was probably 13, 14 years ago. A couple of you, David, I actually recognize these names, and Steve is on here. So anyway, I've met so many of you guys over the years. This will be, I had no idea what level anybody was at, but looking at some of the names on the list, you guys are a fairly advanced group. So I'll throw out anything I had planned, and we're just going to go off the cuff a little bit, which is much more exciting for me as well. And as Carlos said a moment ago, we don't need no stinking charts. I'm not huge into technical analysis, which is much to the chagrin of some of the people I work with right now. So I've known John Carter for years. He's, John's a big time kind of market technician, and it's just not my thing. No matter how many charts I try to get into, Jim, I think you need to go on mute right now. No matter how many charts, I look at and kind of get into, I'm much more about probability. I'm much more about strategy in terms of the trades that I build. So over the years, I've been a big-time premium seller. But if you're looking at markets right now, and pick it off at the SPX, and go to the trade cabin here, open up option statistics. I mean, what glory is there in selling, this IV percentile, which is ultimately a 10% right now? You can do it, but if you're going to sell premium, it's going to be a little, slim out there, and you're going to have to allocate yourself according to the fact that we've been at the lower ends of the volatility spectrum now for years. Sure, we got a burst of volatility in August and September. And I'm hoping that some of you didn't have like the giant iron condors on then and get ripped, one way, get ripped the other way. Come on, anybody want to actually admit that over here? But this is going to be good stuff. People are asking think or swim questions. Hey, I'm actually able to answer those now, except if I answer them the wrong way, I'm going to end up in the Chicago River the next time I go back. But if you've been a premium seller, you've had an extremely difficult 3 months. I mean, some August, September, October, they haven't been all that glorious for you as a premium seller. And the previous 5 years, it's been challenging because we've had a one-direction market. So many of you, if you are premium sellers, and just by the number of people that are in this chat room and recognizing the names, okay, I know one thing. If you've been in this business as long as some of you have, okay, you've been selling premium. Okay, you haven't been like, the most wild directional trader. It's something that you may do on a day-to-day basis. But I will tell you one thing that I've learned over the years. Okay, the ones that survive around that campfire are always the premium sellers. It's been a challenging 3 months, and I'll be curious to hear what many of you get out of premium selling and ultimately what you're doing in essence to be effective in premium selling. So first and foremost, and then I'll open up the SPX. Okay. One thing that I have found extremely effective in kind of the lower volatility stance that we've been in for such an extensive amount of time. And again, my own feeling over here, this is more what I think, not what I know. Okay. I don't think we're going to see as low a volatility, okay, in the next, let's say, year to 18 months that we've seen in the previous few years. Like, throw it out the window. We're now going to go into an environment where the interest rates are going to be unstable. We're going to see the S&Ps get thrown around a lot. I think that selling premium in general is going to be one of the most effective strategies. Not that it hasn't been useful, okay, over the duration. Right, but it's going to become like the centerpiece of everybody's trading again. And you're going to hear, there's not too many people talking about like iron condors that much anymore. And there's a lot of variations of iron condors, but in the end, it's all the same crap, right? You go out, you sell some out of the money premium, okay, and it's more than just praying that it ultimately works. But where I'm going with this is that in the coming months, you're going to see directional bias be more and more challenging, okay? And this is going to be, again, predominantly because the bond market is keeping everybody on the edge of their seats, which it has on a day-to-day basis. And I think we've already seen the beginning of that. And volatility doesn't just go, to sleep overnight. This is something, again, that we're going to be facing without hesitation. I say in the next, year to 18 months, I would consider substantially more volatility specific to the SPX than we've seen in the previous 5 or 6 years. Anyway, let's move past that. One of the things that I've actually found very effective, and it's not something I readily discuss on like a day-to-day basis. I've done a few classes about it, but I'm selling premium for duration right now and pulling those trades off well before expiration, and I've had substantially more success in essence doing that. So when I say selling premium for duration is I'm going out like 86 plus days, okay, and I'm going to be kind of specific at what I've been doing because we're talking about probability and volatility. First and foremost is if you just take a look at the SPX on a day-to-day basis, the vol skew, what is it? Okay, volatility is generally low in the shorter duration and increases in longer duration, okay? Unless, of course, the skew flips over, which is, we're in the midst of some extreme movement over there. But the point I'll make with this is, so you go 86 days out. Forget about specifically what we're going to sell. Doesn't matter. Okay, it really doesn't. Like people get so infatuated with, I sold like a 10 delta and I did this and, let's not worry about it. You sold some out of the money options. Okay, some calls, some puts, okay? And either you sold them naked or you sold them in some type of hedged position, And what's a hedge position? You can use an iron condor. You can diagonalize it. I mean, that's it. If you hedged it, you either use some kind of an iron, which is a vertical spread, a combination thereof, or use some type of a calendar. Okay. In this business, when it comes to like a defined risk strategy, what do you got? You got verticals and you got calendar spreads, and that's pretty much it. So in some way, shape, or form, you sell out of the money premium 86 days out. And assuming that volatility doesn't move too drastically, and let's take that assumption, okay? For granted right now, we'll just take the assumption that volatility doesn't move that drastically. Because in the previous, let's say, I don't know, since basically 2012, okay, we've had a very similar volatility skew. The vol alone drops throughout time. You can almost think of like volatility decaying. So vol goes from like 18.3%. And if you just look until, 37-day option, drops off almost 2 full points. So by selling premium over duration, you've got, 2 full volatility points in your favor. And you're like, what does 2 volatility points equate to? Again, I don't know how many people look at Vega. And Vega's a rough and dirty calculation, if you will, but it's rough and dirty for a 1% move in vol. The options of interest, okay, are going to increase or decrease by, like, in this case, $3.85. So there is a lot that can be captured, right? Not just in premium decay. Everybody's worried about premium decay, but there can actually be a lot captured in the volatility decaying as the asset actually, moves on and starts to waste away. Again, you're worried about premium decay, but you're also getting volatility that is abating as time moves on. Okay. And that's, again, it's a situation that we've been in for such a substantial amount of time. I've had a tremendous amount of success selling duration irons and so forth. And I'll call them duration irons, but opening trades 86 days out and closing them anywhere from about 30 to 40 days prior to expiration. So why open the trade 90 days out and then close it 30 days prior to expiration or 40 days prior to expiration? I always use windows to close things. Okay. I'm actually using that to keep myself away from like negative gamma risk. And okay, long story short, I've been doing this long enough where the issue with most clientele that trade these types of strategies, whether it's an iron condor, whether it's premium selling, and again, I take that for granted that most of you in here are probably premium sellers. And again, the reason I say that is because when I recognize, the people on the list, and I'm like viewing the attendees right now, I recognize over half of you on this list here. Whenever I look at the list and I recognize a ton of the names, okay, I know that you got to be doing something that's probably around premium selling. You probably wouldn't have been around this long. So, and we'll talk about what, the volatility is based on over here. So as you move forward in trading, you start to see things over years. So I kind of worked in the education side. I traded for a few years. I worked in the education side, and then, I ran the education for Thinkorswim for the better part of, almost 15 years. And the one thing that we're afforded the ability to do there, that you can't do on a day-to-day basis, is I see everybody's trades, okay? And one of the common things with premium sellers is they'll sell premium 30 days out, 40 days out. And the moment the markets really start to rock, okay, these options with that short of a duration, it's not a bad thing. It's just that most retail clientele can't react fast enough because the gamma is too heavy on top of them. And it's the rate of change of delta. It's pretty chaotic when you're selling really short duration options. So what I did is I just took the age-old strategy and moved it out in time and had you closing trades, 30 to 40 days out. So why do I even consider selling options 86 days out? I'm intentionally layering stuff. Okay. So when I do this, and, I'm not going to get into intimate details of every single trade, not intimate details of every single delta, because it's not necessary. But one of the most important things is if you want to survive bursts of volatility, okay, you have to allocate capital effectively or you don't stand a chance. And that's the underdog that nobody ever seems to talk about in this business, is that it doesn't, strategy is one thing. Okay, well, what's the strategy? Like I did this iron condor. I was looking at Tom's site, and you guys call it like a weird door. I don't know what a weird door is, but I assume that it's a weird version of an iron condor. Just throwing that out there. Am I at all close?
It's an ace with a put debit spread as a hedge.
Wait, I'm sorry. You have to say that again. I didn't hear it. Was it what?
Okay, it's an asymmetric iron condor, so you're selling more puts than calls, and then you add a debit spread near the money is downside.
Oh, okay. Okay. I like it. I mean, one of the things that I do, I do, I don't call it a weird door, but I call it the bastardized version of the iron condor. So, I'm always trying to offend whenever I'm on. My bastardized version of an iron condor is simply this. Whether I'm looking at Vega or Delta, I'll go out of the money here and I'll actually sell the calls naked. I know some people can't sell calls naked, but I'll get to that. Don't you worry about a thing. Okay. And then I'll actually sell the put spread. So it's a three-legged beast. So a tripod, I don't know. You can call it anything you want. But I like to sell the calls naked. And the reason I like to sell the calls naked, but I'll only sell a put spread, is I don't really fear the upside. I fear the downside. Why don't I fear the upside? Okay. So I don't fear the upside because 2260, that might be plausible in the next 86 days. I think we all could agree, like, hey, we could move to 2260 because we just moved up 200, points in the last few weeks. Oh, wait, it's a chart. There we are, 1880, and here we are, 2120. And you tossed your cookies right here when we crossed above about 2020, huh? So a couple people tossed their cookies in at that point. But the point I'm trying to make with this trade is, so why do I sell the calls naked? And I have risk, but if we explode to the upside, volatility contracts. So this option is very manageable. If we go down to like 1825, volatility explodes. And this option, if it were naked, would be unmanageable because the volatility would explode in the 1825. So I use a spread. I mean, that's my own kind of version of the bastardized iron condor. And if you don't like the margin held up in this, because it's a lot of margin, like you kind of have to have a portfolio margin account, just go use the SPU options, which is the S&P futures options. And the reason you can use those is the futures options. You can go, there's not as many expirations, but you can go your, 79 days out, 100 days out. Clearly, the markets in here are a little wide because the markets are, roughly speaking, closed right now. But you can go out to like that same kind of delta and sell a couple of these. And then let's go to the same one. What did I use? The 1825, 1815. I don't even know if this is the same trade, but roughly speaking, okay, you got to do a few more contracts. But what is the margin in this little monkey? It's not half bad. It's $1,800, for a one lot, but this is half the size of the SPX. So it'd cost you, $3,800 to do this trade in terms of margin for two contracts. And it's just, again, kind of the same bastardized version of that iron over there. But I like to talk about, like, again, why I'm doing such duration. And the duration is not only the way to stay away from like negative gamma risk, the duration gives me plenty of time to layer multiple trades on. One of the things that I don't think a lot of people have enough respect for is when you do, okay, and this is one thing like I have learned over the years of watching order flow of clientele. And that's the kind of stuff where it doesn't matter like where you come from in the brokerage industry. If you had the ability to watch retail clients on a day in and day out basis for 15 years, like you start to learn, okay, this works, this doesn't work, this works, this doesn't work. And one of the areas that I can point to directly that does not work in markets is if you just put on one huge trade and try to defend it. And we've seen this like this life cycle again and again. And I'm going to talk a little bit about this because there's areas in this business where I think I can make you a little better. And capital allocation is a big one. And it's always like this underdog. People don't focus on it enough. But if you go out and sell that one big trade in whatever whatever the trade happens to ultimately be, if you're short a ton of these 1810 puts, that's probably where we're going to. Yeah, I wish there were 1810 calls, and I wish we were at 1600 in the S&Ps, but that's a different story. But I'm saying if we go down to 1810, what's your defense strategy? And we all have defensive strategies for the marketplace, but what happens if we open, tomorrow at 1850? What does your trade really look like then? And defense of it is critically important. So I build a trade 86 days out. I let some time pass. I allocate more capital and more capital and more capital. And I tend to layer these things over time. And the reason I'm doing that is before you know it, you've got capital in 58 days, 64 days, 72 days on different strikes and at different volatility levels. And that way, you let the market move, you allocate. You let the market move, you allocate. And let's see if I can't pull up a drawing tool over here. See if this won't screw up my screen too badly. But sorry, I'm pulling up some Camtasia tools right now to make sure I can draw on the screen. The reality of this is what I'm trying to create, is ultimately this effect. And this is something similar I've been talking about. When you do an iron condor, your risk graph is going to look something like this. So this is, period, if you will, 1. That's your first allocation. So then the market rallies up a little bit and you layer in another, trade. All right, so there's the next trade, and this is, we'll call it P2. Before you know it, we rally even further. Now you've actually allocated into 3 different. This is P3. So these are all period 1, 2, and 3. They can be separated by, you're going to want more separation than just like a week over here. You're going to want some decent separation. And the reason I'm allocating effectively like this is at any given point in time, granted, we can go from here, likely in the markets could rip down substantially, but the chances of it knocking out all 3 periods simultaneously is greatly diminished. Not to mention different allocation, different time frames. Then when we do have the big sell-off, we all realize it's the best point to allocate. You've probably got another allocation, period 4. At minimum, I like to be allocated to 4 to 5 different expirations. And then when you've got this conglomerate mess on, obviously you're pulling trades off and putting new trades on continuously. I do not myself manage positions by individual strikes. Like I never open up the 86-day options and go like, oh man, I'm short the 1820 puts. I'm getting killed over here. I'll actually manage everything via its delta. So I'll manage the aggregate of the delta. And I usually beta weight to the spiders, but I'll take delta risk. And everybody's delta risk is different, but I'll take delta risk of a comfortable level where I'll say like, I'll take comfort of plus or minus. I mean, my delta right now is about 4,000 SPY deltas. And that's what I do throughout, a day-to-day basis. So I'll take plus or minus 4,000 spider deltas. And if I start hitting the outer cusp of the 4,000 deltas, I just chop some risk off. Let's go out there and buy or sell a future. So if I have to buy a future, because I'm too short, and I'll buy a future, all of a sudden it knocks me down to 3,500 deltas. Now this is some fairly substantial directional risk. You got 4,000 delta risk, on. If we move, if the SPUs, the S&Ps move 30 points in a day, that's $3 in the spiders. I'm taking out the gamma over here, but you're going to be up or down probably about $15,000 with 4,000 spider deltas of risk. That's $15,000 with a $30 move in the S&P. With a $60 move in the S&P, it's quite feasible that you could be upside down, just depending upon your hedge. In essence, you could be up or down, $20,000, $25,000. Again, that's if you're quick to the hedge. But to be effective in doing this, you have to have a certain threshold for risk and not exceed it, whether that's 400 spider deltas, whether that's 4,000 spider deltas. That's what you need to come to grips with. And somebody said, markets don't crash to the upside. I don't know. I disagree. The last few days out there, I mean, that was pretty brutal in terms of upside rally. I'm sure a lot of you guys felt that way. There's one thing I'll say to the upside. Even though this is an explosive move to the upside, I have been in this situation numerous times, and this down move, okay, that down move, they can be terrifying. If you're on the wrong side of this, it can be absolutely terrifying because you wake up like on August 24th. We were limit down. It's a 7% down move. What are you going to do? Okay, I'm going to talk about that here momentarily versus the up move. Volatility is contracting. And I've never been in a situation, like I've lost money to the upside. Clearly I've lost money to the upside, but I've never been in a situation where I'm like, oh, I can't hedge my upside risk. Upside risk, I think, is easy because volatility is, again, ever contracting. When markets are exploding to the upside, you just go, oh, I'm getting too short delta. Buy a future. Seems easy enough. Okay. And when you start introducing those futures and delta hedging, okay, listen, futures have, whether you're long, whether you're short, pretty much undefined risk. And a lot of you guys trade in defined risk equations. So when you start to introduce this future, over the years, a guy I've worked with by the name of Frankie Walsh, and Frankie is always called the futures. He's called them chocolate-covered hand grenades. And he's right. They're beautiful for hedging off risk, but there's things, they can cost you more than the premium you could even collect. So what's the point of having them? The futures are effective, though, if you start to trade a little bit more size out there. So I don't like to call what I do delta neutral. I'm not really into the term delta neutral, but a lot of times I'm market neutral. And market neutral to me means comfortability with the positions. Market neutral ultimately means I'm taking like plus or minus a certain amount of delta risk. And I say plus or minus because there's times where my risk is, it's what I want. Like if I want to be short right now, great, I want to be short, but I do not exceed X amount of directional risk. And whenever you're using delta risk, you always have to beta weight it to some property. I always use the spiders. It doesn't mean my risk is predominantly in the spiders. A lot of times I'll carry risk in the SPX, but I'm more comfortable understanding the spiders because it's dollar increments, whereas the SPX, in a wild day moves $60. It's too hard to figure out the math behind the SPX. Okay, especially when you guys are calculating deltas in the SPX. The SPX, again, even when we used to make markets in the SPX way back when, people would still calculate it as 1/10 of the SPX. And I encourage you to consider maybe just calculating your deltas and so forth in SPY. It's easier, and the reason it's easier, quite simply put, when you go to the Analyze tab and you're going to use the risk profile, the SPX, again, from a delta standpoint, you can go in here and you can go set slices, 11 rows of 2% step. And this gets a little bit confusing, but when you use the spiders, the reason I like the spiders is there's this set slices, and set slices $2 and $5 out of the money. Makes it a hell of a lot easier, right? We go up $2, down $2, up $5, down $5. That pretty much covers you in kind of either direction, if you will, on the spiders. Because like a $5 move, that's a pretty big one-day kind of move on there. Whereas the SPX, you got to start putting tons of different slices in there. $50 up, $50 down becomes vastly more confusing from a delta perspective. So yeah, throwing some fairly large concepts at you guys at like lightning speed over here, just to get you thinking differently about your positions. I will take a breath and read a couple of the questions over here. So do you buy or sell the future regardless of price action in the future? So Dwayne, I'll buy or sell a future, okay, based on risk and risk alone. Like I will not look at a chart and assume I think anything. Okay, there are two different parts of my brain, and they've always been separated. And you're like, yeah, everybody, the left hemisphere and the right hemisphere. No, I have the what I think and what I know. Okay, and what I know is that every thought I have is ridiculous. So what do I know? I know how to manage my risk, and I'll never actually break through whatever my delta barrier happens to be, like my threshold for pain, I'm going to tell you guys right now, it's about 4,000 spider deltas on a day. I'm not going to make or lose more than about 15 grand in any given day. That doesn't mean I'm actually going to make 15 grand in a day. It means that's the most I'm willing to lose in a given day. So it's plus or minus, okay, about 4,000 spider deltas. And even if we got, and somebody goes, well, what happens if we move $80? If we move 80, points inside of the futures, what are you going to do then? Okay. I'll hedge, but what happens if we move, against me 80 points at the open? That would have to be an 80 points up day. And, I'll probably take some decent sized heat. There's not one kind of risk management and one size that fits all. It's variable depending upon what some of your positions happen to be. In other words, if you need 500 positive deltas, do you just buy without looking? And the answer is, If I need positive deltas to a portfolio because I'm hitting my threshold for pain, I'll just buy a futures contract and kind of be done with it. And then there's times where if I'm kind of bored on an intraday basis, I'll scalp in and out of my hedge numerous times throughout a day. If the futures are up 30 points, I'll sell a future, buy it back, sell a future, buy it back, and I'll actually use my hedge as a vehicle to trade against. Okay, meaning like I'll actually take my hedge on and off throughout the course of the day and see if I can make a couple of bucks that way. It's way easier than like there's people sitting at home all day and they're like, we're going up, we're going down, we're going up, we're going down. And they've got their, their intraday, 1 day, 5-minute chart over here. This is a 1-minute chart. And they're looking at this stuff, intensely throughout the course of the day, trying to think about direction. What I'll do is I'll just take my hedges on and off throughout the course of the day. It makes you impervious to short, choppy directional moves. You'll never use a stop order again. That's a whole nother discussion. I mean, trading it's very it's just multifaceted, but there's so many different levels of this. So you're like, you're allocating capital over time. I'm hedging via deltas. I use the Greeks extensively. All right. And I use the Greeks so much because, how can you manage 4 or 5 different expirations simultaneously without using the Greeks? I mean, if you're into some product and you have a lot of inventory in there, like if you go to the SPX, okay, this is just an SO account, but I've got a simpler options account, but I've got a bunch of accounts in here. But if I go to another position and, I've got, POS, position, and you open up your order book and, your monitor tab, if you're seeing like 15, 20 positions, it's a pretty daunting task to try to manage each leg of the position. So I just manage it as an aggregate. A lot easier. It's inventory management. And every trading firm pretty much on the planet, that's how they look at it. They're like, this is an inventory management business. You want to be the Amazon, if you will, of trading. Except you want to figure out how to actually make money and not just lose it every single quarter like Amazon. But that's a whole different story. By the way, is taking my hedge on and off the same as gamma scalping? Not exactly. Scalping gammas is usually long the straddle and re-hedging to delta neutral. So, you know what? So people are asking me some really specific questions. So which volatility model do I use for the Greeks, the vol spiral, individual implied volatility? Okay, we're going to get down to it now, aren't we? All right, you want to pressure me on the models over here. First and foremost, I will never tell you precisely how that 15.86 is calculated. There are certain things and certain areas of math that I shall take to the grave with me, okay? But I can tell you the expected move over here, if you're kind of curious how they solve for expected move, this is not the exact equation, but the expected move calculation doesn't use this implied volatility. It does not use this implied volatility. So it sounds like we got a bunch of engineers on here. Come on, the geeks speak first, right? So the geeks, the Greeks, it's all the same thing. So you take the stock price, which is roughly 2075, right? You multiply it by volatility. But the volatility you want to use, just use, okay, the at the money put, 1 strike in the money, 1 strike out of the money, at the money call, 1 strike in the money, 1 strike out of the money. Average those 4 options average their implied volatilities together. So if you were to look at a, because I can see the questions coming in on this, but if you look at this 14, this is 14.3, these are 12. So the average volatility in here is actually like about 13%. It's about 13, and it's right around 13%. Okay. So the average implied volatility in here is about 13%. And then you take the 13%, you multiply it by the underlying price, and multiply it by the square root of 30 divided by 365. It'll come out in that neighborhood of plus or minus 76. So the volatility being used in that expected move equation is vastly different than the implied volatility here. The implied volatility over here is actually derived from, it's averaging tons of out-of-the-money options in either direction. It's a much more like holistic approach to it. Anyway, in terms of implied volatility models, I always use individual implied volatility. But this is an excellent, excellent question. So, all the years of Thinkorswim, I always get the math geeks. It was either myself or Tom Preston that handled all the math geeks over the years. And, I didn't know it when I first started working for Thinkorswim. I didn't know I was a math geek. And, I don't consider myself by any shape or form a math geek. But what I do know a lot of is like how these models are built and how they're derived. And the one thing I can tell you is the individual implied volatility model, okay, so that's what I use. People look at the individual implied volatility model and they don't like it. I strongly suggest that you stay to the individual implied volatility model because it'll impact how the Greeks are calculated. There are two schools of thought in the trading world. One of the schools of thought says you should use implied volatility of individual strikes. The problem with that, though, okay, is if you look at what's called probability, for instance, out of the money, it's calculating this probability out of the money based on the individual option implied vol. And this probability, which says like 90% here, this is going to differ vastly from what the Analyze tab does. Why? If you ever looked at like Analyze tab and you look at the probability analysis in the Analyze tab, let me reset the slices, not completely new, but if you look at this probability curve, this is based on 13.61. If you go back over to the screen, you won't see 13.61 anywhere here. And the probability in the Analyze tab will differ substantially from what you see in the Trade tab. That's intentional because we had some internal battles at Thinkorswim, like which implied volatility model should we use? Then we basically said, screw it, let's just build both. So the Trade tab adheres to those that they like to use individual implied volatilities. The Analyze tab uses what's called a VIX style implied vol, and the VIX style implied vol at 13.61. If you take a look at where the VIX is right now, now we're really going to get into some nitty gritty, right? If you look at the VIX is different, okay, than what it says for the Analyze tab. Okay, there's actually a reason for that. Can anybody tell me the reason? Why would the volatility be different for the SPX? A 30-day volatility be different from the SPX than it is from the VIX right now? Okay, this is like $1 million question because I'd be ridiculously shocked if anybody got this right now. How could it possibly be different? Anybody? No, Analyze tab is not using statistical vol. It's using real-time vol. Nope. This would be like one of the ones that's really tough to get. See, a lot of people, they ask questions all the time about the VIX and the VIX and the VIX and the VIX and the VIX. They changed the calculation on the VIX last year. I think it was October 6th of 2014. They changed the calculation of how the VIX works. The VIX is no longer just an average of the monthly options in the SPX. The VIX actually commingles all of these weeklies as well. The calculation the Analyze tab on Thinkorswim is still actually based at 13.61. It's actually still based on the old VIX equation, okay? And yet there's a new VIX. So it's kind of like a catch-22. This equation eventually be updated, but the amount of calculations per second that would take is infinitely greater. So what you're getting in here is a slight variation from the VIX. And you're like, oh, my head just cracked open like a cantaloupe. It's okay. By the way, it's a fine number to work off of as long as you're consistent. It doesn't matter at all. So there's always these arguments about like how the Greeks work on Thinkorswim versus how they work on some other trading application. There's True Delta. The one thing I will tell you about Delta, about all the analysis, okay, there is no one platform, okay, that might be better than another. It's just levels of consistency. And that's the one thing I'm going to like drive home to you, because one trading application says the delta is 8 and another trading application says the delta of that option is 10. The irony is actually it doesn't matter at all as long as you're using, for instance, one analysis tool to ultimately figure out what your net delta is. So in hedging deltas, you can see some pretty vast differences, you know, from one trading model to the next, and, you know, different trading applications. So we did a ton of research on this, and we looked at like Stenson model, binomial model, Black-Scholes model, and even those were kind of like a joke. Like they change your deltas, but they change them mildly, right? The binomial to a Stenson model, and it changes the P&L slightly. But we found the most important thing was, well, it didn't really matter as long as you were consistent from one trading application to the other. This number, though, does make a difference. This volatility number makes a big difference, and I'm going to show you why, okay? When you're calculating probability in trades, the probability is going to differ. Like if you calculated it from the trade tab to the analyze tab, it's going to be different. Because if I were to look, let's look at the 37-day options, and let's look at the 2150 strike. So the 2150 strike, 37 days out, shows that you have an 86% probability of that option being out of the money. Okay, 86%. Let's go over to the Analyze tab. And again, let's look at the strike. It's 2150, right? Go to the Analyze tab and go into price slices. And let's delete a bunch of slices over here. So, yeah, we'll go in here and just delete a few slices out. Come on, slices, delete, delete. And just type in a slice over here at 2150. All right. So we're going to go in here and we're going to go 2150, enter. Okay. Now let's look 37 days out. What's the probability? Okay. What's the probability being below 2150? 79%. It's pretty different, isn't it? Okay. So it's 79% here, but over in the trade tab, it says 86%. What's right? Now that's what I was getting at. The two different schools of thought. Okay? This is based on an individual options implied volatility. Now I'm going to tell you which one I personally recommend, and it differs from product to product. If you're trading a lot of SPX and so forth, the Analyze tab is a pretty good way to go. Okay? And so it's all about consistency, but the Analyze tab is a pretty good way to go and use the analysis off the Analyze tab. Why? The SPX and index-related products, the spiders, the SPX, the Russell, the NDX, they always have a lot of skew. So the skew is what really, you know, screws up the probability much more. So when it comes to index and index-related products, I'll use the analysis tab to figure out my probabilities. Okay. If it's an equity-related product, most of the equity-related products have a lot less skew. Okay. And the skew is the differential of the out-of-the-money puts to the out-of-the-money calls implied vol. And as such, okay, again, I find that using for equity products, the trade tab is fine. For index products, I'll use a little bit more of the analyze tab. And that's my own kind of liking. And that's why both of them are actually built, you know, different ways in Thinkorswim. So anyway, any plans to really old school and somehow use the OEX in the VIX calculation? The problem with the OEX today, there's not enough depth and liquidity to even use it. If you look at the OEX, that's about as old school as it gets. Like if you look at the liquidity in here, just go to volume and open interest. Nobody's trading it. So one of the things you got to understand about implied volatility is as good as the market is making it. And people get very fixated again, like on implied volatility and so forth. And that implied volatility, people ask, where's that 15.3 really derived from? It's just bids and offers. That's it. The 15.3 uses a mid price, or what's called the mark. The mark and the mid are the same thing. And, you go after the middle of the market, and that's it. Then it averages a bunch of the pricing together. The individual implied volatilities on the platform, these individual implied vols are just based on the mid price. You can actually sit with a Black-Scholes model and revert out implied volatility. If you have implied volatility, you have price. If you have price, you have implied volatility. It's just pieces of a jigsaw puzzle out there. Okay. Anyway, that's all right. VIX is today's vol. So the VIX is not tradable. I always say that too. So not only is the VIX not tradable, to me, the volatility products are some of the most misleading products in the entire marketplace. Very few people really understand these volatility products. They're such convoluted products because there's, contango and backwardation in them. And what people really, you want to see like the ugliest product pretty much in the market, look no further than like the VXX. Okay. The product decays. The actual product itself decays quite readily over time. I love to show this, but I don't know how many people have looked at this. This is a 3-year chart. Has the VIX really gone down that much? It's from 150 to 18. One of my favorite things to do then is to bring up the life of the entire product over here. I'll just go to a weekly, but literally it's gone from 7,000. If you bought one share of the VXX, it was $7,680, and it's now at 1890. Most of the volatility and volatility-related products have lost 99.98% of their value in recent years. It's because of the decay of the physical product. It's dragging these products. I call it decay. It's really called drag, but it has to do with the differential in pricing from front month, of course, to back month over there. And that's why I like the VIX itself. I don't even look at the VIX that much anymore. It's not a tangible product. It's just based on a calculation of the SPX 30-day implied volatility. I think the vol futures are substantially more effective in what's really going on in markets. The volatility futures have a lot more, especially on an intraday basis, of effective knowledge of, hey, this is a tangible product. It is being bought and sold right now. 150 contracts have traded in the last few minutes since this product reopened over here. And that's why, again, I think it's a much more tangible product. The VIX options, of course, are based on the VIX futures over there. Reading back in a few questions. By the way, Tom, if you see any specific ones that you want to grab, by all means, I'll try to answer them over here.
I think you're keeping up pretty well.
Yeah, I'm cruising back over there. By the way, many learn the craft of trading, so net seller. Yeah, so I am definitely, and by all means, I have been a seller of premium, but I'm not like, I do differ from, I know some of you guys probably watch Tasty Trade and like Sosnoff, and, Sosnoff is, he's two things, always bearish, okay, so he's always short, and he's always short premium. I'm not always selling a ton of premium. Like, yeah, I'm a premium seller, but I have tendency to, right now, I'm trading a lot against individual stocks. So I'll be short a couple of stocks, and then I'll sell premium against those stocks. And one that's notable right now is, so I'm short some Apple. And I can't even tell you guys how many emails I get in a given week about how could you be short Apple? People are pretty much accusing me like, it's un-American to be short Apple. And I'm like, listen, I own every freaking product from them. I am not buying some 12-inch iPad, though, today. And I went down to the Apple store here in North Scottsdale last week. I met a buddy down there. There was literally a line out the door. And, of course, the first question my friend had is he turns around, he goes, so you're going to cover your Apple position while standing here in Apple, seeing the line out the door? And I'm like, oh, hell no. I'm much happier with it now. One of the reasons I like to be short, okay, right now is, quite simply put, I guess Apple's a pretty good way. It's a 10-year on Apple. Who wouldn't want to be short this? No. I want to be short markets right now. I don't like the risk reward in markets. It's a pretty simple take for me. When I say the risk reward, I mean, could Apple continue up? Absolutely. Could it go down? Oh, yeah. But from a risk reward standpoint, let's say in the next 6 months, I think there's a lot more downside than there is upside potential, period. But what's actually also helping me is skew. So the inverted covered call works really well because if you look at the option, so here we are at 116. So let's just go a little further, a little closer in. So this is $6 out of the money. So let's go $6 out of the money in the on the call side. And if you look equidistant out of the money on these, and I know I'm jumping around a lot today, but you can collect $1 for selling a covered call, but you can collect like $1.30 for selling the exact equidistant put. So I would rather be short stock and end up selling the puts because the skew is helping me out a little bit. Okay. So what I really do though is I'll be short, for instance, a few hundred shares, and then instead of selling, let me go over here and show you delta really quick. Most people sell right around like between a 20 and 30 delta, or sometimes 30, 35 delta. Sometimes I'll go all the way down to like a 16 delta, and if I'm short 500 shares, I'll actually sell, double the number of puts, and I'll trade against my position that way for a period of time. And that's kind of a lot of what I've been doing. So I'm selling puts against a short stock position. Make that clear, because I am physically short the stock. And if you don't want a short stock, you got to use a synthetic. You got to go like in the money, buy some in the money puts, something along those lines. But I think the skew is helping me pretty substantially because right now, premium's hard to come by. Looking under option statistics here, it's the 23rd percentile, right? Premium's hard to come by. You're getting a little extra juice for selling puts rather than selling calls. And that's, again, I'm not telling you to always sell option premium, and I'm not telling you to always be short. That's what I think, It's not what I know. What do I also think? If you look at the SPX, you could have made this argument 22 months ago. I did make the argument 22 months ago. But if you look at the SPX right now, and this is, again, a 3-year weekly, you got to, who doesn't want to be short this, right? Straight freight train to the upside. But the out-of-the-money puts, if you're short S&P futures, it affords you the ability to sell out-of-the-money puts uninhibited in markets. Even if we run up, whatever, I'm going to sell some puts. And the puts that you're collecting, look at the premiums in here. I'll start 30 days out, go down to like 2,000 strikes, $15. You go the same distance. So that's $70 out of the money. You go the same distance out of the money in the calls, you're collecting nothing. That's $3. So skew can help substantially. And to be, again, very, very specific in my own trading. So right now I'm short some Costco. I'm short, I'm actually short my biggest position in the whole market right now is in the XLF. I think actually part of my position's in this account. So I'm short 7,100 shares of the XLF. Look at it again. Don't get scared. Don't throw up. I'm short 7,000 shares of the XLF, which beta weighted is not that many SPY deltas, but I don't sell options in the XLF. I'll sell my options over in the SPX. So I'm short Costco, I'm short Apple, and some of them have had these tremendous run-ups, but the down move helped me harvest enough premium that I'll be just fine over here, and I'll continue to sell, these out of the money puts. And again, I might be short the XLF, but I'll use the SPX as my premium selling device. It's one of the ways that portfolio margin kind of equals everybody out. Like I like portfolio margin because I can do stuff like that, and I'm kind of uninhibited. I don't have to think about how should I use my capital? How should I use my margin? It's a lot easier. By the way, yes, I love Costco, and I really do. I like going to Costco, but when you look, people always ask this question. Like when I look at that stock, we're going to look at the chart. We're going to look at the chart over the last 3 years. I don't even care about the last 3 years. Let's just zoom over here. Here's a 9 month. It hasn't really done very much. By the way, I've been short for a huge amount of this time. I upped my position though substantially just recently. So, which is not I've upped my short position, which has not been advantageous yet. I am not broken even in Costco yet. I'm about $6-7 away from breaking even in Costco on a few thousand shares. So do the math over there. I'm upside down pretty good in the Costco trade, but I got them right where I want them. This is Costco for the last 9 months. Most of the retailers have suffered pretty miserably. Me, I picked the toughest retailer to try to short over here. There's a bunch of other retailers that are starting to break down. Oh yeah, I'm short Target too. I am short Target. So take a look at Target position. I'm short 700 shares here of Target. It's up 5%, 700 shares. Unfortunately, I'm also long Walmart, which is, that's not good. You know, I'm also long some Walmart. So if you take a look over at Walmart, it's equally as impressive to the downside, maybe more so. And they're like, oh, how could you be long Walmart? It looked interesting, you know, but positions like this, again, I can sustain them for long periods of time and just finance them, you know, and I finance them by trying to sell some premium against them. And the ones that I'm short, for the most part, they're fairly easy to finance that premium against. Okay. All right, I think I got all the questions answered here. So, guys, fire away a little bit. And, you know, in terms of questions, I saw a couple of Thinkorswim questions come up. Again, I can't tell you too much because I don't want to end up with cement boots in the Chicago River. It's still Chicago, and if you've ever actually been to the Thinkorswim office, it's literally on the Chicago River, and they have possibly thrown people in there before from the office. Okay, some intentionally. It's that's what they do. Anyway. I think I got the Vol Smile question in there. Okay, on the short puts versus short stock, any delta objective overall? Yeah, so I can tell you what I do and then maybe what you might want to do, okay? So if you're into a position like Apple, generally speaking, I'll go to a 30-day option. Most of the time I sell like weeklies and I just roll them and roll them and roll them and roll them and roll them, okay? But right now, if I were to sell, I would sell the 9-day options, and I'll use further out of the money, and I'll sell like a bunch of these 109s. You're like, well, why would you go that far out of the money? Okay, because if I'm short 500 shares, instead of I could sell like a 10 lot of these. Again, that would eat up quite a bit of margin if you didn't have a portfolio margin account. But in this particular case, you know, I'll sell like the 109s, and I'll sell, you know, sometimes even like 20 of them, 20 contracts worth against my short position. And you go, what happens if, you know, the market comes down quickly? If the market comes down really quickly, I mean, do the math. If you're going to go from 116 to 109, you're going to make roughly $6-7 on the juice from the stock coming down. And with only 9 days left, there's not going to be, look at even the at-the-money options are trading for $1.36. So in the worst case scenario, you just cover them. You just cover the options and lose some money on the options because you made the $6-7 on being short the stock. It's not going to be the end of the world over there. Apple actually gave me a nice downward move in the last 2 trading days, but I'm still short. So my original entry to this position, some people saw it. I did some nightly videos. Original entry to the position was pretty much smack dab at 130. I covered at 110. And then I reshorted. I actually thought it was going to break down in this neighborhood. I don't mind showing you like totally wrong. I thought it was going to break down, okay, in here. And it hasn't. It actually shot back up, and now it's starting to break down a little bit. So I'm only $6 off where I reshorted it. But again, my original entry into the position was 130. So I'm fine. But even if you look like where I've shorted it, I've already got a couple of weeks of premium that I've sold against it. So net, I'm sitting at about my entry cost is, you know, like I've shorted it closer to about like 113. It's not the end of the world over there. I'll be just fine. Okay. So yeah, by the way, that type of trade works really well in with PM portfolio margin, since one of the short legs hedges the other. Everything works well in portfolio margin. Like it's kind of nice sometimes to be out of the brokerage world, because people are like, so what do you really do? And I go, well, I sell a lot of crap naked, but when I sell the stuff naked, like I have something to be able to exit it, right? I have something like to be able to hedge. I don't just sell naked and hope. I don't like that. it's a rough strategy to sell and kind of hope over there. Anyway, I've eaten up pretty much hour of everybody's time over here. I'll let Tom or Jim hop on, fire a couple more questions at me. I took most of today off too, Veterans Day, and kids were off school, so things got crazy over here. There were diapers flying left and right. I didn't hit Costco. I didn't hit Walmart. Okay, I was at Sam's Club yesterday. I will admit to that. Yes, I have memberships at both. So as painful as that may be, and I'm still buying a bunch of crap. Yeah, kids are they're 1, 3, and 5. They a lot of diapers. A lot of diapers are flying over here.
Yeah, but those ages, you need a lot of energy. My youngest just turned 23 today, so it's been a few years since the diapers were full.
Oh, man, there's light at the end of the tunnel, though, for you, I don't see the light. And if you just, by the way, my whole notion about them going to school, college, is that the colleges are going to, I've convinced myself that college costs are going to implode in the next 15 years. So I won't have to have $1 million per kid per college, because otherwise, $3 million later, I will send my children through school.
Well, right now you need about $250,000 now.
In Germany, the tuition is €206 per semester. Just food for thought.
Well, you're pretty happy that the euro is about to crash and burn a little bit more. I think we might see the euro at par here in the next 6 months. Yeah, in the next 6 months, the euro at par with the dollar would be nice.
It helped my mortgage immensely. Don, I really appreciate it. Is there anything you want to say about simpler options, or do you guys have anything going on that we should know about?
No, not too much. I'm going to do a class. I mean, again, this is a more advanced group, so I'm going to be doing a class this Saturday. It's simpleroptions.com/short, and it's the exact tactic of how do you get short Apple, which options do you sell, how far out do you go in time, what delta, when do you roll it, all the little nuances in there. Again, it's a fairly advanced group over here, so I kind of surmise that most of you are pretty comfortable with those ideas. So I went a little bit more concepts and so forth today. But by all means, check us out there anytime, and email me. So if you've got some follow-up questions from time to time, I'm usually a few days behind in emails now, but I'm just Don at simpleroptions.com.
Fantastic. So Don, really appreciate it. Maybe we can have you back in the future. It's really nice to finally meet you. Just finally talk to you, and thanks for your time, and thanks for everyone who sticking with us for the whole hour. Really appreciate it.
All right, guys. Thanks a lot. Appreciate it, too.
Thanks, everyone.
Tom, thanks very much. Don, thank you so much for stopping by. We really appreciate it.
All right, everyone. See ya.